Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
Hello everyone and welcome to Investing Insights, where once a month we do the video version of Investing Insights. And this is where Steve and I chat around everything property. We give you tips and use our experience, our decades of experience in property investing to guide you through the market phase that is happening right now. And today we also have a special guest, a regular friend of RPG podcasts, and we will introduce him in a minute. But Steve, I understand that you had to actually swim across the channel to get to this podcast today.
Yeah, once again, Vic, we are flooded, or we're half flooded. We're not fully flooded. So just a lot of our roads are closed, but that's part and parcel, isn't it? Like I can control a lot of things, but the weather
certainly
is not one of them. The other thing that I can't control is that the studio's different today. So we're all sort of back to front.
Now, for the listeners and for those of you who have been following us for quite a while, Steve's a creature of habit. So we've thrown him today by putting our special guest right next to him. And so he was trying to, turn the tables on me and get me to introduce. So give me a yell if you think my introduction was better than Steve's, so that we can certainly throw him on the reviews.
Do you know you were going to say thumbs up then because you thought you were doing a Facebook Live?
I thought I was on Facebook Live.
That's it.
There you go.
Where we're not.
But let's introduce our special guest, and he is special in the sense that he is the go-to person in finance and the director of MLS Finance, our good friend Sze Chuah. Welcome, mate.
Hey guys, how are you?
We are good. We don't.
It was a rhetorical question. You didn't have to answer.
Do you want the truth?
I know we are good, but I don't know whether you are with the way the interest rates are going.
No, you're right. It's a downtime at the moment. It's doom and gloom, and I think we're probably approaching the end of it. That's probably the thing we can take from today, that it's starting to slow down. We had our first 0.25% increase after a run of 0.5% increases. So that's probably the silver lining, if there is one. And I think it's not going to be, the acceleration is going to be there for the next.
Well, there's a bit of a theory around that the 0.25% was just to give us a false sense of security as we walk into Christmas, so that people are encouraged to spend during the Christmas period, and then look out in the February rate call where back up to 0.5%. So it's yet to be seen. I don't even think they know, the RBA know what's happening, let alone us speculators trying to have a dig or guess at what the next 4 or 5 months will be, because it's just so dynamic, as we all know. And the fact that we got a 0.25% this month, this month? Yeah, this month. Yes. It's bizarre how the mind works, because suddenly you think it's only a 0.25%. It's like, let's group hug and high five on that. But it's still a 0.25%. And when we add them all together, clearly it's a big whack.
It is
the most in decades.
10. No, it was the first increase for more than 10 years.
Yeah,
right?
and this has been the fastest rise of interest rates in 35 years, right? So that means that a lot of people that have been investing, first of all, haven't seen interest rate rises, and equally importantly, a lot of people haven't seen this fast an interest rate rise. All three of us, we are blessed with the fact that not only do we deal with people with all walks of life, but we've actually been through the hard yards of investing during the really good times, investing in the challenging APRA restriction times. And in fact, Sze, that's when you actually started in the mortgage business in that sense. Yeah. So you know how to handle these changes and delivering the bad news to some people as well.
That was an amazing initiation, because one day, lending was loose as anything. And then, the next day lenders were going, yeah, remember that pre-approval that I gave you 2 weeks ago? Yeah. We don't actually do investment lending anymore.
But it's the same even for investors, like you think further what you said, Vic, about people that have never seen a rate with a 4 in front of it, let alone anything over 3.5. Because they're new to investing, so they think that's the norm. Yeah. Whereas if you go back to I don't know, years back. Go back to the GFC where rates were quite steep in comparison to what they are today in terms of the cost.
Yeah, 7 and 8%.
Yeah, the people, and I truly believe this, the people that invested, who started investing during the GFC are such well-rounded investors today because they started at what was typically the worst time in terms of all the ingredients. Whereas you've got the other investor that started on the, and I'm being very general here because there are some people that approach investing systematically and so methodical, and there are others that just do it because everybody else is doing it. And I think they're the investors who have done it in the last year or so with no forethought, but just I've got to because everybody else is doing it.
Yeah.
They're the one that will become resentful,
Yeah.
especially as we go into this environment.
Yeah.
But, and I clarify this environment, it's not bad.
No, it's normal.
That's the Back to the Future. Maybe that's the heading of the podcast, Back to the Future.
And we've got to remember that, like, to temper all the interest rate rises, on the other side of the ledger, there's the rental increases that's happening to balance it up. So, whilst I said bad news earlier, it's kind of bad news qualified.
Yeah. Look, I believe that any change in property, right, investing or home ownership, has always got a silver lining to it, right? So when we're going through the strong interest rate rises, like you said, the rents are also increasing in parallel. There may be a bit of a lag, but we already had a big surge of rental increase during COVID, and now it's still going up.
Yeah.
And when the finance cycle goes through its own cycle and the rates start coming down, the rents actually don't come down as sharply, right? So what it does is if you're missing out right now, you could really capitalize down the track when the finance does become easier. And it's not too far away, I believe, when it starts becoming easier. And it certainly will help with the capacity of people being able to borrow at that point in time.
Absolutely.
So let's corner Z.
Why not? He's in the corner
He's
anyway.
in the corner. No,
The wrong
puts
corner.
baby in the corner. It's so what we'd like to do today is get your thoughts on how to preserve find our capacities, I guess, and in some cases how to enhance it. We're also going to drill you for some predictions.
Yeah.
Now,
please.
the predictions. So I'll give you a couple of minutes to think about it. There's some elevator music. Where the rates will stop. What will they be? What changes to the banking policies, buffer rates, which is a huge one that nobody seems to want to talk about at the moment because it's in the background, and how that could be changing. And because you see a lot of investors, what your thoughts are on the value of the asset over the next 5 years.
So where do I start? So
Well, I was going to give you time to think about it, but should we just dive straight into it? Let's start with where it is today and where it was 12 months ago, in terms of today back then I could borrow $1 million. What can I borrow today? Like let's put some context into this to see just how much the rates have affected serviceability.
So I think overall, you would say if you mixed owner occupiers and just pure homeowners and investors, you'd be looking at a borrowing capacity decrease of about 20 to 25% minimum. Okay, and I'll qualify that by saying some investors will be hit harder than others, because not only are they taking out new debt, but there's all the existing debt that they get buffered at that assessment rate. So it's not just, again, the new loan that they're taking out for that property, all of their other existing properties. What the bank does is adds a 3% buffer on it, gets the assessment rate. And just to give a bit of perspective or context around that, so if we're seeing general investment rates at say 5.5%, 6%, let's call it, the buffer is now 3% as opposed to 2.5% as it was 1.5 years ago. So if we're saying the overall assessment rate is 9%, you compare that to the APRA handbrake that happened in 2017, and generally the assessment rates were about 7.25, 7.5%. So it is actually harder, like a lot harder to borrow these days compared to when APRA pulled the handbrake 5 years ago.
It's a very interesting point because where we are today in the market in terms of that supply and demand ratio being so undersupplied, which we all know, and we've talked that to death. But the beginnings of that, and some would say the catalyst for where we are today is because of that APRA handbrake pull, which was in and around the serviceability, so the buffer rates and what have you. And there was some tweaking to policy. But if we're in a worse position today in terms of that serviceability piece, we're already undersupplied, so therefore the participation rate today is not there, then how do we solve the problem of being undersupplied and providing accommodation? How do we participate if we can't get the money?
So and there's other factors in there, right? So the cost of building is so high.
Correct.
Amount, right? So that's gone up 20, 25, even 30%. Then you've also got the trades shortage as well. You can't get, there's a lot of builders that have gone under because of COVID. So when you have all of these things, then you've also got the weather to play with as well, right? So all of these factors make it really hard to invest, or even if you have got a house, there's a lot of people that had plans to put a granny flat or do a subdivision or a secondary dwelling in there. They can't, even though the intent is there. They can't, and you're seeing more and more of this, aren't you, Zeke?
Yeah, and I think the policymakers and the regulators are going to recognise that eventually. But to your point, almost I'd say 2 out of every 3 people that we see these days, we've just got to say, sorry, your serviceability is capped. There's absolutely nothing you can do. And to your question earlier, Steve, about if you could borrow $1 million 12 months ago, how much can you borrow now? Probably about 400,000.
That's huge.
Yes, huge.
That is
60% reduction.
And because $1 million, let's look at both sides of the ledger there. $1 million today will still buy you a lot of areas, quality assets. But if you can borrow if you can only borrow $400,000 today, that dramatically reduces those slithers of opportunity throughout the country where you can deploy that money. And the next question is, would you? Like it's such a dynamic that, coming back to your remark around policy change and potentially somewhere in the future, and we'll get to that perhaps a little deeper in the minute, it just, the participation rate, once again, is not there. And so how can the problem be solved? And if the problem can't be solved in the near to medium future without there being some massive changes, whether that be the lending criteria or the policy, whether it be government incentivised or incentives for people, first home owner grant, like a stamp duty, et cetera, then how does the problem be solved, and how does that mean that we have a spiralling upward trajectory rental market? Or will that then be played with and tinkered with in terms of legislation state by state by how much you can do it? So it's a diabolical position for the entire economy, for the entire country. And I truly do believe it, and I've said this probably 6 or 8 months ago, it's a checkmate position because you're damned if you do and you're damned if you don't as policymakers.
That's right. I want to qualify our comments here today. This is not all about doom and gloom, and this is not about batten down the hatches, the storm's coming. Because all 3 of us have gone through the situation where we wanted to expand our portfolio and we could not get lending for the life of it. But then all of a sudden, the policies opened up and bang, we're back into it, and we're lining up to buy the right types of properties. So the message we're trying to give here today is that you need to get back to your fundamentals in terms of be in touch with the broker, have the ongoing conversation with them so that they know what your intent is, so that when there are policy changes, they've got your information on hand and your desire to borrow, in what area you're borrowing, and what whether it's self-managed super fund, whether it's investment, whether it's even upgrading your home or just simply restructuring your mortgages. Then you can then be front of mind to be able to take benefit of that change in lending criteria, change in assessment rates, whatever changes that's coming to help you, so that you can be the first cab of the rank. And there's usually, as you would know, Steve, every time there's a policy change or crisis, there's usually a gap in the market before people get up to speed with the information to then take action.
It's an opportunity, and I'm glad you said that this is not a doom and gloom episode. It's not. It's actually quite the opposite.
Yep.
But we need to say it how it is. I mean, lending is lending. It's a game of finance. Property is just the vehicle. So we really need to, I guess, know what our cards are and what the hand we've dealt before we start playing. But it is an opportunity, and if for all our clients and those that perhaps have been listening over the years, where we've always said keep a degree of liquidity, especially 12, 18 months ago, good valuations, draw down, because that could be the top up. You might only borrow 400, but if you've got 300,000, 400,000, 500,000 in equity that you've liquidized, if that's a word,
that's the word now.
then it's a top up to be able to use until that policy changes. So not negative or positive, but we need to know what we are dealt with.
You know what? That's actually really good advice that you've been giving your clients, because and right now it's demonstrating, it's been demonstrated in finance, because low LVR lending right now is slightly easier than the 90%. You know, the 90% third tiers, like we're pretty much out of the horse is bolted. But if you've got a deposit of 20%, some cases 30%, you're going to get better pricing. Right? And what does better pricing mean? It means lower interest rates and lower assessment rates as well. And if your assessment rate's lower, then your borrowing capacity is higher. So what we're seeing a lot more of is people who can potentially put a smaller deposit, but they're choosing to go a 20% deposit or sometimes 30% deposit, and they're able to expand how much they're able to borrow. They're able to squeeze out to the next price point for that property.
Yeah. So I guess when you look at finance and the finance cycle and the investing cycle, so this is your personal investing cycle. If you're starting out, obviously the initial advice to someone that's starting out, take away today's market, is that you want to minimize the amount of capital you're putting into it so that you're going 90%, 95%, right? Sure. But as the finance market changes, what we do need to do is then start looking at, okay, how many other lenders can look at my scenario? And when you've got, from what I understand, when you got 80% lending, you've got a whole lot more lenders opening up as opposed to 90, right?
Absolutely.
Yeah. And as a guide, you being the expert, let's say, argument's sake, I'm coming to you to borrow, and I say I want to put as little capital as possible into the deal. Sure. And I can qualify, say, with the second and third tier lenders. Yeah. What's the difference in assessment rate between, say, 90% and 80%?
It's huge. Right now, like you're looking at probably more than 1 to 1.5% in terms of interest rates, because the 90 is really starting to get penalised heavily now. So, we're looking at some third tier lenders, you're looking at a 90% investment rate of over 7%. Okay. So that means the assessment rate's over 10%. And like, who's going to qualify,
Yeah.
And so I guess what we've seen over the last couple of months is there's been a small window, and that window is still in place for a few of our clients, a few of our existing clients, where we fixed them in at really low rates over the last few years. They've got very low interest only actual repayments, and that's where the third tier lenders come into their own in terms of their generous borrowing capacity, because they look at what are you paying now. They don't care whether it's fixed, variable, fixed for 1 more month or 3 more years. We don't care. Interest only, P&I. We just look at your repayment, and then we'll use that to determine how much you can borrow. So there is a limited window. It has been a limited window for some people, and we've even seen some people switch their owner-occupied debt, which we've always said, go P&I, pay down and chip it away, go interest only, just for that slightly smaller repayment, so that boosts their borrowing capacity. So there's a kind of a limited window over the next, I saw a statistic the other day, $150 billion worth of fixed loans are expiring over the next 3 months, just before the end of the year. right? So
it's a big amount.
A big amount. So there's going to be a lot of pain, next year.
Yep.
Where people will switch over, but the flip side to that is that some people can take advantage of that.
That's right. Yeah. So for the listeners now, if you've been thinking of this fixed rate is about to expire, my interest only is about to expire, and you've got a few months up your sleeve, don't leave it till too late. Contact Sze, and we can get the ball rolling in terms of being able to get you to restructure your mortgages. It's really important as part of the investing journey. What we've seen as a collective, the three of us having invested over many years, is that you do need to every couple of years restructure all of your mortgages, right, to get efficiency back, to also pre-plan for what's happening in the market over the next couple of years.
Reset your interest-only terms, reset your loan terms, fix in pool equity. Yeah, it makes sense. Yeah.
But as you say, Vic, to be active in that now. There's a lot of things that you can do to help that serviceability piece. So actually on that, because the preservation of our serviceability, or how do we actually make it better, we know the get rid of bad debt, all that sort of stuff, which is quite important. But in an escalating environment that we have today in and around the cost of money, what are the things that people can realistically do to either preserve what they have in terms of that capacity or enhance it?
Yeah, like we were saying earlier, rents have been going up. Not just on Eastern Seaboard, but across Australia. So, if you've already got properties, then really go in and make sure that you're at market. Because I just had one of mine. The agent called me last week, and they said, you're $50 under market. I was like, oh wow, that's amazing. And then that made me have a look at a couple of my other properties, and I sort of noticed that some of the other agents were saying, oh, why don't we put it up $20 a week? And then I kind of looked at market, and that they were quite short from that. So I think probably go in and review your rents, but also challenge the
property
agents.
managers.
Yeah, go on Domain or realeestate.com and look at what else is comparable and challenge it, because what the agents are wanting to do is just have the least amount of friction with the tenants. Just go in, do bare minimum, and not have to work at finding another tenant or risk doing that. So that's really going to help offset all of these interest rate rises and the assessment rate rises. The other thing that you could do is really look at, if you've got some surplus cash, look at paying down your owner occupied debt. Hold off from big renovations or that next car purchase, and use it to reduce your owner occupied debt, because again, that gets penalised really heavily compared to the investment debt. And whilst the interest rate might be a little bit lower, it's still considered non-tax deductible debt. And with the investment debt, you get the benefit of a tax add back, which lenders factor in. So, if you've got $500,000 worth of investment debt and $500,000 worth of owner-occupied debt, both from a tax point of view and also a borrowing point of view, you're going to be a lot better off paying, if you've got a spare $100,000, not just offsetting your owner-occupied, because the lenders will always look at what your limit is, and excluding any offset, but actually going to the bank and saying, I want to do what's called a bulk pay down of my home loan from 500 to 400. I've got 150K spare. I want to keep 50K as a risk mitigation, pay it down from 500 to 400. And you're only left with 50K in your offset account. But at the same time, what we can do is top up your investment loan by 100,000, and then all of a sudden you're using that as a deposit for the next property.
So that's very clever restructuring, where you're using the money on hand to actually enhance your borrowing capacity.
Yeah, absolutely.
Actually poses a question that I get asked a lot, where there's that term out there, debt recycling. Well, we all know what it is, but I want you for the listeners, because I would be asked that every week without fail. What is debt recycling?
It's basically that process that I just talked about. So you're converting or recycling non-deductible debt to deductible debt. So you can only do that if you're using your debt for either investment or business purpose. So for those self-employed followers, that's another option as well. If you're looking to invest in your business and you're open to borrowing to do that, that's something that you can consider. But in the investment world, it's about shifting, if you've got that 500,000 owner occupied, 500,000 investment debt, using that example that we just spoke about, we're converting the owner occupied debt to 400,000, and we're stepping up the investment debt to 600,000, and all of a sudden you're in a better borrowing position because you've only got 400,000 of non-deductible debt, and you've got 600,000, 50% more deductible debt. And that'll actually help your borrowing capacity.
This is as far as the lending calculator is concerned, isn't it?
Yeah, absolutely. And not to mention that we're also resetting, like I mentioned earlier, that we're resetting the loan terms to be amortized over 30 years again. Because if you've had 3 or 4 years run on your home loan, all of a sudden you're being amortized over 26, 27 years, and again, the way you're assessed is a lot more harsh versus, over 30 years. You've squeezed out another 10% borrowing capacity.
I'm going to bet you that 70% plus of the listeners would not have known that.
Yeah.
Like, without fail. So that's a very, very good point. And this is, I guess, why it's so important to have that open communication with your broker, that collaborative approach. It's actually very important that your entire team can collaborate on your behalf. So the broker speaking to the advisor speaking to the accountant, that cyclical nature without any third-party privacy issues, but which is a lot of the clients know what we're talking about. If you don't, we can explain that in another podcast. So what about non-productive debt? We've always talked about credit cards, personal loans, car loans, and the like, how detrimental they are to your capacity.
Yeah.
Has anything changed? Like, we know that interest rates are going up in the resi space and the commercial space.
Yes.
But how much is that non-productive debt scenario, the loans, how much are they going up by? And has that affected, or does it have a compound effect on the overall serviceability?
Yeah, absolutely. So, where 12, 18 months ago, you could get a car loan for 4 or 5%. Now it's going to the exact same car loan is going to cost you about 7 or 8%, right? So that means that those car loan repayments are higher, and that obviously will take away from your serviceability. So they are still being factored in. They will still be detrimental, and probably have a more sort of a compounded effect, because everything else, all of your other debt is serviced higher. It's kind of like the straw that breaks the camel's back, right?
Especially when if you've been reduced from $1 million to 400, just as the example, and you've got $70,000 worth of car debt, which is what, $350,000 odd dollars equivalent of mortgage debt.
Yeah, exactly.
That could be the difference between being able to execute on an opportunity and not even being close.
Yeah, exactly.
So important.
Yep. And this is where obviously the whole team comes into play: the accountant, the broker, the advisor. I'm going to step in grey area here in terms of novated leases, right? So one of the things that employers do is entice you with a novated lease.
Yes.
And that's one of the biggest no-nos in terms of lending, because that certainly kills it, right?
Absolutely. Because with a novated lease, they'll go, it's really tax effective for you. And whilst that's, true from one perspective, you can emulate the same structure most of the time with your home loan or even an investment property. If you borrow against the equity of that, sure, your rate's going to be similar, but your repayments are just going to be so much lower because they're amortized over 30 years rather than the 5 to 7 years that you get with a car loan or a novated lease. The novated lease, I see a lot of them and you've got two components. You've got a pre-tax component, a post-tax component, and they're like $1,200 each, depending on the car, obviously. But like that just blows a massive hole in your serviceability.
That's right, and I guess that when you're investing, you have to look at the holistic picture, right, and have a balancing act between your tax structuring as well as your investing finance structuring. And this is where the broker and the accountant need to be on the same page. And often what happens is that most people sit with the accountant, and the accountant brings in a tax perspective without taking into consideration the knock-on effects of borrowing, the knock-on effects of being able to refinance, the knock-on effects of adding to the portfolio. So you can never have it too much to one side, right? You can't just focus on borrowing, nor can you just focus on tax. You need to be fairly in the middle ground so that you can have the best of both worlds in line with what you're trying to achieve this year, next year, maybe the next 3 years, so you can structure accordingly all of the moving parts to be able to borrow more, to then take advantage of the market as it unfolds.
I think that's why it's so, and we would all agree on this, why it's so crucial to have an accountant that is proactive rather than reactive. And what we really mean by that is just, and no disrespect to accountants, that if your accountant sees you once a year and you go there at the end of the financial year and say, here's my stuff,
it's too late.
Work your magic. Then it's a moot point. You're not really getting the true worth of what an accountant can do for you. Being proactive, what are your goals? What are we trying to achieve for this coming financial year? Yes, we may have a tax problem, but we're also trying to create a wealth position. So we need to balance. It's that type of narrative back and forth rather than, well, here's a shoebox.
Yeah, exactly.
Full of stuff. Get me a return, please.
Yeah, that's right.
And there's such a big difference. So the importance of that proactive accountant is
very
crucial.
important, very important. And look, the same scenario applies to finance as well, right? You don't go to your broker after you've exchanged the contract, especially in today's market. Actually, just to interrupt for 1 second, how hard is it now, if at all? I mean, if you service, but how hard is it to get that conditional approval should you want to go to an auction? Has anything changed in that space?
Yeah, really good question. That's probably been the other major challenge in this environment, where we have lenders that once you're pre-approved, for the life of the pre-approval, the 90 days that you've got usually, it's rock solid. It doesn't matter what happens with interest rates. But we've been in the environment over the last few months where you get a pre-approval, and then the following months,
the assessment rate
the interest rates rise, assessment rate rises, your borrowing capacity drops, and then all of a sudden, you were pre-approved for 500,000, you're not approved for 500,000 anymore. And there are some lenders that will not necessarily honour that. So it has been a little bit of a minefield.
I would also say there's a bit of not a gamble, but there is the potential issue for valuers also.
Valuation has to come up.
The val has to stack.
Yeah.
So on whenever the drop of the hammer, whatever the price is, then the valuation, it might even be a little bit smarter and risk adverse to have a lender valuation before the auction, just to make sure that in a market full of sentiment that you're still stacking up.
Yeah.
I guess what we
Ze's looking and saying that's a bad idea. That's just more
more work. More work. I guess we're not saying that don't buy at auction. We're saying don't buy at an auction unless you're fully prepared. You've got contingencies in place if you're not able to get the full LVR, if the valuation comes in lower, because it's not that you haven't bought well. It's just the lender's risk appetite in that area, the valuer's risk appetite in that area. There's so many moving factors over here that really we need to take into account.
Absolutely.
Before you actually can say with surety that there is certainty with lending.
Especially in today's environment. What about that? Actually poses another question. What about postcode restrictions? Are we starting to see sort of LVRs being knocked around on different postcodes or different asset types?
Probably not as much, but what back to the previous point about the pre-approvals being honoured, I think you're 100% right around certainty in lending is really the key, not just for the borrower, but also for the lender, because things are changing for the banks, right? So their cost of funding is increasing monthly, whatever. But what we're seeing is, if you do change your mind around the finance product or structure with a lender, all of a sudden you're deemed as to be not pre-approved under the previous policy anymore. So under the previous rate, where again, a lot of lenders will provide that certainty and say, look, you're pre-approved for 3 months, we're going to honour that. But if you start changing your mind, go, actually, I'm not going to go interest only, I'm going to go P&I, or vice versa, or fixed variable, whatever it is. If you're swapping something around, all of a sudden you're not pre-approved again.
Well, that's the bank's opportunity to pass on the new changes, isn't it?
It is. So it's just a massive minefield, because the expectation is, hey, I'm just changing a product. Like, I was already pre-approved. You told me I could borrow 500,000. Now you're telling me I can only borrow 420, but I've already found that property.
And there is the problem. I mean, with participation and the like, when you have such a reducing, or when you have such a changing goalposts, the market is trying to react accordingly. Now, having said that, there's still a hell of a lot of money in the market. There's still a lot of people that can borrow a hell of a lot of money.
Sure.
And so those transactions are still happening, which is very, very important. What are you seeing in terms of intent versus ability?
So in terms of intent versus ability, there's still a huge amount of people wanting to purchase or refinance, especially as rates start to escalate. They're wanting to ease the pain of the higher repayments. Or the flip side is, they see it's an opportunity. When there's confidence down, you guys have seen it, cycle after cycle. When's the best time to buy? It's when confidence is down, when interest rates are going up, or when the pandemic's hitting and everybody's going, oh no, the world's ending. That's the best time to buy. So a lot of investors, especially the sophisticated investors, the experienced investors that have seen those market cycles, they're like, oh, this is great.
Yeah, we've been waiting for this.
We've been waiting. Yeah. They're not competing against the hordes that are willing to pay overs, over market value. So they're thinking, this is great, but the ability is just not there. Like we were saying, the serviceability is the harshest we've probably seen for about 10 years now.
I'd say even
more.
More, yeah.
It is.
To be serviced at 10% or thereabouts.
That's
or
pretty
calculated.
GFC. That's pretty GFC.
That's huge. And if you just sit back and let that sink in for a minute, at 10%, give or take, it's clearly no wonder that the participation rate has fallen through the roof, as opposed to a mere 12 to 18 months ago.
Yeah. Like assessment rates were 5.5%.
Yeah,
6%. Owner occupied.
It's crazy.
It's
crazy. And so I guess the question is then, when do you see a change? So it's a two-part question, and this will be on the net forever and ever.
Hit record.
Where do you see, or when do you see rates starting to taper off? When do you see rates potentially adjusting downwards? We'll start with those two first.
So I think, given the impact of the rate rises thus far, and the slowing, I think it's only going to increase by another 0.75%. So, and that's kind of in line with what the majors are forecasting.
That's not all in one go. It'll be incremental too.
Look, I think, if I obviously just had a 0.25%, we'll have another one before the end of the year, and then we'll have a couple more next year. So, the majors are saying anywhere, cash rate of anywhere between 3.1 to 3.6%.
Which is still reasonable.
It's reasonable.
Yeah.
It is.
And when do you see, this is the second part or part 3 of the question, could you see that the banking system via the regulators change the assessment rate. So it's change the buffer rate, which would allow more participation.
It has to. It has to. Yeah. There's no question that in this current environment and the upward trend of interest rates, that it's sustainable to have assessment rates at 8 to 10% plus. It's just it's going to exclude too many people. So the banks, I'm already starting to see that they've recognised that, and they're starting to tinker around the edges of certain credit policy. So, Westpac just last week came out and said, we're kind of broadening the medical policy. So it's called medicos. Usually, it's doctors and dentists and specialists and so forth that get their LMI covered up to 90%. It's now including midwives and registered nurses.
So they don't have to pay mortgage insurance up to 90% if they qualify.
Yeah, that's
right.
P&I. That's right. Some lenders will allow interest only.
Yeah. Why that's such an important piece is that what it shows is that particular lender is trying to find a way to make money, to lend.
Yeah.
Because ultimately that's how they do make their money.
Same as with the self-employed area. So there, for a while there was only one or two banks really that gave the flexibility of looking at only 1 year of financials and tax returns. Now there's a couple more sort of coming in, and some of them are the restrictions, up to 80% and so forth. But there's a few more to the table now, and there's also tinkering around the edges of how they kind of take self-employed income. So if you're paying yourself regularly as a self-employed person, all of a sudden there are a couple of banks that'll look at 6 months of you've been paying yourself. It aligns with bank statements and your tax records. We'll lend based on that, and we'll exclude what's in the business.
What about for those that are salespeople that have a big piece of their income is in and around commissions?
Yeah, absolutely. So there are still lenders that will say, okay, well, you've had a good 3 to 6 months. I'll just lend on that. Don't show them any more. That's a tip of the day. But most of the lenders are going to say, well, show me 2 years, because sales income can be lumpy. But if you find the right lender, they'll still do short-term commissions income, which is massive.
So this is where the broker, the finance advisor, is actually understanding their client. So it still comes back to what information you share with the broker. And the bigger picture, so that they can actually work with all of that to actually get you to your goal.
So be upfront with us, guys. Like, we're working for you. We will strategically, within the rules, not bending the rules maybe, but not breaking the rules, we'll present you in the best possible light to the lenders to give you the maximum chance of success.
I think that's a very important point, because often people think that brokers are on the bank side, for want of a better term, but it's not. Like, be fully upfront, full disclosure with your broker. Let them make the strategic decisions.
Yes.
Because that's what they do every day. Don't you assume as the borrower anything.
That's right. I guess in today's market, with the positive credit reporting, right, the undisclosed credit card that you might have forgotten that you actually still had open, right?
Yes.
That can kill a deal.
It can, because the reason that kills a deal is because somebody's making a decision at the end of it. It's a subjective decision. There's a human being, not just a computer system. Yes, your deal gets run through a system and an algorithm, and it spits out a decision. But ultimately, the person, there's going to be somebody going, yeah, that sounds like a strong person, a deal or not. And what they're doing is not just making an assessment of your situation, but they're making an assessment of you as a character. Is Victor a good borrower? Can we rely on Victor? And if
that's a short story.
If Victor's not being completely upfront with me, then and I've found out something that he hasn't been forthright and told me, then that's not a good reflection on Victor's personality and character.
Yeah.
So, I'm a lot more hesitant about the deal all of a sudden because, nobody likes unpleasant surprises, right? Like, it's like, wow, I don't.
So one of the things I do before I apply for finance, and finance for me, as you know, is very, very complicated, right, with the portfolio we control. The first thing I do is actually get a copy of my current credit rating, because there are always lenders pinging the credit rating in terms of checking as part of their process, right? The annual reviews as an example and all that sort of stuff. And there could be a credit card there that you thought you had closed or have never used for 10 years, but it's still lying there dormant, ready to be activated at any point in time. It shows up on your credit rating. It's better to have all of that information up front and be able to share that with the broker so that they can approach the right lenders based on that information as well.
Absolutely. We always do that on behalf of our clients, but if you're using a bank direct or another broker, then absolutely you want to go armed with any questions that you might have, any concerns, and again, be upfront with them around, this is what happened. And, sometimes it's something that happened 20 years ago. We had a deal knocked back, a couple of years back with a bank, and they said, declined. And we went, why? Everything checked out as a strong deal. There was service, is within policy. Well, what happened? They said, no, it's just declined. And it wasn't until we kind of dug deeper. We used our BDM. We've got a very strong relationship with them. So they, under the table went and looked in their systems, and they went, it was actually a missed payment in 1993 that happened. So we've actually just it just came up in our credit scoring system, and not
one missed payment, or was it like a year's worth or something?
Yeah, no, it was enough to be trivial, especially given the time. Like that's a long time ago. Yeah,
it's crazy.
It's like 30 years ago.
So that's a good, I guess, example of the banks finding a reason to say no.
Yeah.
And this goes to the open closed door policy. There are certain times when banks will close their doors because their book is full.
Exactly.
And there are times that the bank wants to open the door to lend out as much as they can. And you touched on it. A great example is Westpac at the moment. On this day, 2022, that is super aggressive. In the marketplace.
Absolutely.
And there are lenders that were aggressive 6 months ago that now don't want the business, in a really dumbed down way, I guess.
And I think that's a really good point, because banks' sort of appetite, peaks and wanes based on what their book looks like. And there are some lenders, absolutely, Westpac, that have been so into investment lending and so aggressive in filling their book over the last 3 to 4 years that my feeling is that in the next 12 months that's going to wane, and where CBA up to 3-4 years ago they were the same, and then they've kind of not completely shut off the gates, but they're so much more stringent.
They're not doing anybody any favours.
Yeah. I mean, and the pricing reflects that.
Correct.
And their appetite, that's being driven by their appetite and the state of their book. But, given that there's been a slowdown, I would expect, like a CBA over the next 12 months to really start ramping up again.
And this is nothing new. This is a finance cycle, right? We've seen this before.
Yeah. And who knows, he might see the 95% plus LMI turn back.
Soon.
Yeah, I hope they don't. I really, really hope they don't, because I think that's a dangerous place to play in, personally. But what I do think will happen, and I guess this will play into the way that you assess and which lenders, is New South Wales have said, we are doing the stamp duty change now, and we're going to trial it with the first homeowners. We've seen that other states are starting to talk around policy change.
Yeah, there is change afoot everywhere.
There's change afoot, and it's the collective approach to get the money into the system to supply accommodation. Once again, participation. So I guess as brokers, you guys have got it cut out for yourselves in terms of changing policy and all these intricacies that are in the pipeline. They're coming, but I guess that's what you guys do every day.
Oh man, I can't personally keep up with the change myself. Like it's just the norm now. Like the constant change is the norm. So you're like.
Mm-hmm. Gone are the days where it was, how much money do you want? Sign here, press hard. Third copy's yours. Away you go.
We had a laminated copy of all the interest rates because they never changed for years.
Yep.
There's only one interest rate. It was for investment. Interest only. 95% was the same as 80%.
Yep.
It's just.
I wonder if
easy.
I wonder if, speaking of the investment rate, I wonder if they'll change it for investors.
Interesting thought.
Will they? If you want 90%, you'll be penalised accordingly. But if you're 80%, we're going to dramatically reduce.
But they're kind of doing that now.
Yeah, but I mean really harshly or hard, more effectively to get people to do stuff.
Maybe it may be around the assessment rates in itself, right? So 90% would have a different assessment rate.
That's what I'm referring to, yeah.
Just after GFC, that's what they tended to do is if you're 90 or 95%, it was a different assessment rate to 80%. Now, that'll open up the floodgates for you.
Because they can't just do it for the homeowner because there's only a portion of people, as there are only a portion of investors as well. But to solve this problem in and around accommodation now, you actually need both sides of the fence. You need the owner-occupier to participate and you need the investor to participate. But if the cost of funding for the banks is X and they need to make a profit, well then how do they get the money into the system and still make a profit? I don't know. Interesting.
Yeah. So we have obviously talked all about finance, and obviously the listeners might have other questions. Sze, how can they contact you?
MLSfinance.com.au.
There you go. So go onto the website and make sure that you mention this podcast so that we can be able to track how we are able to help people in this changing market, because we just like you, we want to find innovative ways to bring you information that's pertinent so that you can take benefit of today's market, the changing market, both in finance and investments. And for your questions, you can come to questions@rightpropertygroup.com.au or come to our website, rightpropertygroup.com.au, and hit the contact me page. If you wanted to sit down with either myself or Steve, if you're an existing client, again, just come to either Melanie or Jenny to get a time in our diary, because it's important, as we discussed today, with the mortgage restructuring and all that, and perhaps how we're going to restructure the portfolio, to have that plan in place first before you then go back to Sze and talk about the finance strategy to get everything all in the one table, so that we are able to then move forward and take advantage of today's market, or be able to restructure your mortgages so that you are actually having a far better flexibility in what you've got. And if you're a new client that you've been listening to us for a while, or you've just found us, you can go to our website. There's a contact me form, and there's a little bit of a process before you sit down with either myself or Steve and Melissa, who's a very well-heeled investor. She has been investing for many years. She will have a chat with you initially to make sure that you get the best of either myself or Steve's time when you do talk to us. So this is Investing Insights. Be sure to share our podcast with your friends and family. And until next time, bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.